All right, let's jump right into this explainer. Today, we're diving into a high-stakes, data-driven breakdown of a massive, structural devaluation that is completely reshaping the software industry as we know it. We're looking at what institutional analysts are calling the SaaS liquidity trap. Now, for nearly 2 decades, the software-as-a-service business model has been the absolute gold standard for investors. And hey, it's easy to see why, right? You build the software once, you sell it infinitely, and you just sit back and collect predictable, high-margin, recurring revenue every single month. It was basically an investor's absolute dream of negative working capital and incredible cash flow. But right now, we are witnessing a permanent paradigm shift that's turning all of those foundational assumptions completely upside down. So we're going to break down exactly what's happening under the hood, and more importantly, how you can position yourself before the exit window closes for good.
Think about the sheer gravity of this for a second. NVIDIA just partnered with ServiceNow, and the market completely ignored it. Literally any other year over the last decade, if you attach the absolute undisputed king of AI hardware to a legacy SaaS giant, it would trigger an instant massive rally. It would be front-page news. Institutional money would just flood in. But the actual reaction this time around? Total apathy. It was a failed pump. And guys, this tells us something absolutely critical about investor psychology right now. The smart money is waking up to a pretty brutal reality. We might actually be in the middle of a SaaSpocalypse. Simply slapping the word AI onto a fundamentally broken, human-operated, seat-based business model, yeah, that's just not going to save it from obsolescence anymore.
Negative 52%. Just let that sink in. That is the devastating drop in ServiceNow's stock over a 12-month period. And what makes this a massive anomaly, and honestly pretty terrifying for the broader software sector, is the context around this plunge. This total collapse happened even as the company delivered what analysts would usually call incredibly sound quarterly results. We're talking about a reported 19% year-over-year increase in subscription revenue and even improved operating margins. Historically, numbers like that give you an ironclad safety net. They signal a really healthy growing enterprise. But instead, we are seeing the total destruction of their historical growth narrative. The market is actively and intentionally ignoring the traditional fundamentals.
To put this into perspective, look at the valuation. ServiceNow is still trading at a price-to-earnings ratio of 53.12. That is drastically higher than the industry average of roughly 29. It is priced for a level of future optimism that generative artificial intelligence has just completely shattered. Let's break down the mechanics of why that's happening. If you run a standard discounted cash flow model today, you project out the next 5 to 10 years of free cash flow, discount it back, and it might tell you the intrinsic value of the stock is over $212. But that assumes those historical cash flows continue uninterrupted. This extreme valuation anomaly, it proves investors aren't pricing the stock on past performance anymore, or even current revenue. They are pricing in an existential threat to the core seat-based software license model itself. They are betting those future cash flows are going to vanish.
So, here is our agenda for this explainer. 1. The ServiceNow valuation anomaly. 2. Death of the complexity mode. 3. Rise of agentic AI. 4. The compute for labor swap. 5. 3 metrics of dying SaaS. And 6. Identifying the 10%. Ultimately, what we're building here is a sector exit strategy designed to separate the 10% of surviving infrastructure companies from the 90% of dying zombies. Let's get into it.
Section 1. The ServiceNow Valuation Anomaly.
We've clearly seen the disconnect where the market is actively punishing traditionally solid recurring revenue. But to navigate this, we really have to deeply understand a core misunderstanding. AI integration absolutely does not equal value creation. This is the brutal truth for investors today, and it is the trap so many are falling into. Just because a SaaS company drops tens of millions on R&D to integrate a generative AI chatbot or a fancy proprietary copilot into their software, it does not mean the customer is going to pay a higher premium for it. Actually, it often destroys the company's margins. Think about the mechanics here. If you build a copilot, your customer is still asked to sit at the keyboard and oversee the work, meaning you haven't replaced the human labor cost. But now, as the software provider, you are absorbing massive API and compute costs every single time the user queries your AI. If an autonomous agent can eventually do the job entirely without the human, that expensive software interface becomes totally dead weight. The underlying value migrates entirely away from the application layer and funnels straight down to the foundational AI model and the hardware compute layer.
Section 2. Death of the complexity mode. Back in the 2010s, if a software product had an incredibly dense, complex codebase with intricate workflows, that was the ultimate prize.
Investors viewed that complexity as an impenetrable defensive moat. It meant no scrappy startup could easily copy the product, and it locked enterprise customers in for years. But that foundational premise? It is now a massive liability. Dario Amodei, the CEO of Anthropic, delivered a stark warning about this. He explicitly stated that leaders relying on the complexity of their code will face total ruin. Why? Because advanced generative models can now instantly deconstruct, audit, and replicate highly sophisticated logic with virtually zero human intervention. Let me give you a concrete example. Anthropic's Mythos model recently ran a single autonomous exercise and exposed nearly 300 deep structural flaws in the Firefox browser. We're talking about a massive, complex system that has been heavily scrutinized by thousands of top-tier human engineers for over a decade, and an AI just ripped right through it in a matter of hours. That massive complexity is no longer a moat keeping competitors out. It is dangerous, unmanageable technical debt.
Now, there is a fierce billion-dollar debate among industry titans about how this actually plays out. Dario Amodei presents the bust hypothesis, meaning moats disappear overnight, legacy incumbents sitting on bloated code bases face imminent bankruptcy, and global wealth shifts entirely to the underlying AI providers. On the flip side, you have NVIDIA CEO Jensen Huang pushing the innovation growth hypothesis. He argues that because AI makes coding practically free, the sheer global demand for software will increase exponentially to solve massive problems in healthcare, manufacturing, you name it. But here's the absolutely critical takeaway for your portfolio. Even if Huang is completely right and the total volume of code explodes, the profit margin you can extract from selling that code plummets to near zero. If bespoke logic can be generated on demand by an AI for pennies, the traditional SaaS subscription model entirely collapses, regardless of how much total code exists out there in the world.
Section 3, Rise of Agentic AI.
Warren Buffett famously evaluates businesses using the silver bullet test. He asks executives which single competitor they'd shoot down if they only had one silver bullet. Well, right now, agentic AI is the silver bullet that is systematically shooting down the entire legacy software application industry. Unlike traditional software, where a human employee has to actively click around a complicated user interface, agentic AI simply operates the computer directly. Tools like Anthropic's Claude or agile open-source alternatives like OpenClaw have the ability to navigate web browsers, click buttons, and audit proprietary data completely on their own. We are seeing a massive enterprise shift toward these zero-setup experiences. Consider tools like SciBySimilar or Telegram-based frameworks like EasyClaw. Instead of an employee logging into a massive ERP system like Salesforce, authenticating, navigating through 5 nested menus, exporting a CSV file, and formatting it, a non-technical user literally just types a plain English command into a chat window. Hey, pull last month's churn data and cross-reference it with a new pricing tier. The agent operates the UI invisibly in the background and just delivers the answer. This completely bypasses traditional IT procurement cycles and starves legacy SaaS companies of the vendor lock-in they rely on to survive.
Section 4, the compute for labor swap.
If the software model is breaking, how are the absolute sharpest companies adapting financially? Well, in the AI era, the ultimate metric of a company's technical defensibility is no longer user growth. It's the highly aggressive, cold calculus of revenue per employee. Look at the operational blueprint Meta Platforms is laying out for the rest of the industry right now. We are seeing proactive layoffs targeting 8,000 employees, executed even while the company is hitting record-breaking revenues and profits. They aren't trimming headcount to survive a recession. At the exact same time, they are aggressively scaling their capital expenditures to an estimated $115 to $135 billion, heavily earmarked for advanced GPUs and massive data centers. This is a highly calculated compute for labor swap. Meta is intentionally liquidating the human labor layer on their balance sheet and transferring that exact value directly into the permanent silicon asset layer. Compute scales infinitely without HR overhead. Human managers simply do not.
And this ruthless mindset is spreading like wildfire. Jack Dorsey, the CEO of Block, captured the new Silicon Valley mantra perfectly. 100 people plus AI equals 1,000 people. Block recently reduced its global workforce by a massive 40%. But the objective wasn't mere cost-cutting. It was to fundamentally rebuild the company into a flatter, mini AGI organizational structure, where AI nodes literally replace layers of middle management. If the companies in your portfolio aren't actively executing this strategy right now, they're falling behind. Dorsey's explicit aim is to double their gross profit per employee from $1 million up to $2 million. That is the exact standard of ruthless operational efficiency the market is now demanding from survivors.
Section 5, 3 metrics of dying SaaS.
So, if you are auditing a portfolio today, how do you mathematically spot the companies that are failing to make this transition? Let's dive deep into a highly actionable checklist for identifying the 90% of software companies that are fundamentally trapped in the zombie phase, completely unaware that their core product is already obsolete. First, look for FTE ARR decay. If a company continuously hypes itself as an AI leader on earnings calls, but its full-time employee headcount is still growing faster than its annual recurring revenue, that is a massive red flag. It means they're burning cash using AI just to survive internally, rather than leveraging it to create scalable value for the customer. Second, audit their UI dependency. If their software strictly requires a human being to sit there and spend hours navigating a proprietary dashboard, it's incredibly vulnerable. An AI agent is going to learn to do that in the background, making the human seat and the expensive license fee attached to it worthless. And third, measure the commodity logic overlap. This one is absolutely crucial. If the core if-this-then-that reasoning of the software overlaps by more than 70% with what an out-of-the-box model like Claude 3.5 can do natively, that product is now a pure commodity. Its premium license fee is inevitably going to zero. Remember that massive 52% drop in ServiceNow we analyzed earlier? That is the ultimate cautionary tale of exactly what happens when these three metrics begin to decay.
Section 6. Identifying the 10%.
Okay, so we've established the structural collapse. Now, let's conclude with the alpha. How do we actually identify the specific software companies that will not only survive the SaaS apocalypse, but actually generate massive asymmetric returns? True survival in the agentic era demands entirely abandoning the traditional application layer and migrating down to the infrastructure and orchestration layers. Here is the exact criteria you need to look for. Step 1. Security and compliance modes. Massive generalist AI agents face immense security scrutiny in enterprise environments. Because of that, companies providing perfectly locked down, heavily sandboxed environments, think NanoClaw or TrustClaw, they are going to become the gatekeepers and capture the incredibly lucrative enterprise market. Step 2. Low-resource specialists. We are talking about edge computing here. Massive cloud-based LLMs simply cannot run on a local factory router or a secure medical IoT device. Tools like PicoClaw that operate flawlessly on under 10 megabytes of RAM form an actual physical hardware moat that cannot be easily replaced by a cloud API. And step 3. Persistent user modeling. Generic models reset every time you talk to them. Frameworks like Hermes that offer deep cross-session personalization and long-term behavioral skill acquisition provide a hyper-customized fit that out-of-the-box models simply cannot touch. Furthermore, you have got to seek out companies with lean code bases, meaning highly efficient systems running on mere thousands of lines of code that an AI can audit in hours. You have to actively avoid the millions of lines of legacy bloat that act as pure technical debt.
We have covered an immense amount of ground today, moving from the collapse of traditional SaaS valuation metrics all the way to the brutal realities of the compute for labor swap. Look, the structural reset of the entire software industry is not a temporary dip, it's permanent. The historical complexity moat is entirely dead, and it has been ruthlessly replaced by the era of the autonomous agent. The liquidity trap is closing quickly. So as you audit your own holdings this quarter, you have to ask yourself a very uncomfortable question. Take a hard look at your exposure and ask, is your portfolio genuinely invested in true, scalable intelligence? Or are you just blindly paying for obsolete human interfaces before the trap permanently closes? Thank you so much for joining me on this explainer, and I will see you next time.